Yeah! Welcome, Patriots. Welcome back to Military Money Mondays. Yes, it is that time again, Military Money Mondays, the weekly live stream where we break down proven strategies to help our nation's heroes build lasting wealth, protect what they've earned, and turn their service into a legacy for their families. So I'm Dan Farnsworth. I'm a retired naval officer. I'm also a licensed financial professional, and my agency, VictoryX Financial, specializes in helping veterans just like you, veterans, first responders, and patriotic families build wealth, minimize taxes, and create guaranteed income that lasts for generations. All right, so I know that was a lot, but let's go ahead and get into tonight's topic. So what are we going to talk about? Well, we're going to talk about your TSP and how to convert that into a guaranteed stream of income that you and your spouse, by the way, if you're married, that you and your spouse will never be able to outlive. Okay, so imagine being able to have that money deposited automatically into your account every single month, just like a pension. That's why we call it the RETIREMAX Elite Private Pension Strategy, right? That money gets deposited into your account every single month, no matter how long you live, no matter what the markets do in the future. And even if you pass away before your spouse is going to receive that income for the rest of their life. So without further ado, let's go ahead and jump into the topic. We'll go ahead and pull up our presentation for the night, and we will get into it. All right, so here we go. So from TSP to private pension. Again, we're going to go over how to convert this into guaranteed stream of income that's going to last for the rest of your life. And we're going to kind of go through it step by step here tonight. By the way, we're using kind of a different format tonight. So if you guys like this, I kind of dig it. But if you like this, go ahead and comment below. And if you guys have any questions along the way, go ahead and drop those in the comments, whether you're watching on YouTube or you're watching on Facebook here tonight. Just go ahead and drop those in the comments at any point. I promise I will answer every single question. Even if I don't get to it right away, I will get to it, I promise, within probably less than an hour after the end of this live stream here tonight. So again, drop those comments below. And hey, if you got any comments about the format of the video here tonight, go ahead and drop those as well, because we love the feedback. And hey, if you're watching from out of town, we're here in Virginia, but if you're out of town somewhere in another state, another city somewhere, throw that in the comments too, because I always like hearing where my listeners are checking in from, my fellow veterans. All right, so let's talk about TSP for a minute. So what is the problem with the just leave it in TSP? We've heard this before, right? We've heard just leave it in TSP, because obviously when you separate from the military, you can't really fund TSP anymore unless you go into federal service. And even then, you have basically two separate TSP funds, so you could potentially have one that you could still access, but then the other one, obviously, while you're still working for the federal government, you would not be able to access until you either retired or separated. So I don't really have anything against TSP. It's a solid investment tool, right? It has low fees. I mean, when you compare them across the board to the management fees that other brokerages are going to charge, it's traditionally pretty low. Each individual fund has its own management fees. But here's the thing you need to know about it. TSP is not market proof. Okay, at the end of the day, you're still investing your money into various securities and funds. Okay, so you're essentially buying securities in the TSP, and then the only way to basically access the money later on is to sell those, right? You have to liquidate in order to, in order to start converting that into income later on. And all the while, you're basically riding this market roller coaster like all your friends and neighbors that have 401ks and IRAs and other traditional portfolios. You're on the same market roller coaster the entire time. Okay, the G fund, for instance, hasn't even kept up with inflation over the last 30 plus years. Okay, it's averaged roughly about 3 to 4% returns. That's typically where people park their money in retirement, especially when they don't want to lose funds, even though the G fund has lost money in the past. I mean, you can look all that stuff up. It's on tsp.gov. If you just go over there, you can see the historical returns on TSP. you'll see where even the G fund has dipped in certain years and has resulted in net losses to overall portfolios. Now, there were two big crashes in the Great Recession era that I think are worth noting. Okay, you had basically a big market crash after 9/11. Okay, which was in 2002. You had another one, the one that we're all kind of familiar with in 2008, where the housing market collapsed. Okay, when the housing market collapsed, the S&P 500 lost 37 points. Okay. The C fund in TSP, which is primarily linked to equities within that fund, again, dropped almost 40 points that year. Okay. So if you had, let's say, $500,000, or we'll call it $1 million even, all right, $1 million in the TSP, in 2008, that literally became 600,000 overnight. Okay. I have personally, I can't count even on both hands and toes and everything else. I can't count the number of clients that I've spoken to that lost tremendous amounts of money during that time. And, if they were young, I mean, yeah, they could probably have recovered. It took about 5 years to recover from that. But if they were young enough, they might be able to recover. But if they were already in retirement and they were already drawing income, I personally know individuals in their 80s that are still working because of the sequence of returns drops that impacted their retirement savings while they were drawing income. And we'll kind of get into here tonight what exactly that looks like, right? So if you need income when the markets drop, you're basically like locking in those losses, and they're going to impact you for essentially the rest of your life potentially. And you could run out of money. I mean, that's the reality. You could end up running out of money. All right, so the mission, therefore, with Victory X Financial, my mission to help veterans is to create a stream of income that you and your spouse cannot outlive. Okay, so what we want for your retirement is very simple. Okay, we want to protect principal, right? We still want to grow the money, right? We don't want this to just become like the old, we call them single premium immediate annuities. You might have heard them as SPIAs, right? These are like your old school annuities, right? And even TSP has a similar program, okay? As you would expect with a typical government program, they're going to have one that's pretty outdated. It's been around for decades, right? If you wanted to just liquidate your TSP over the course of your life, you could do that, right? And all they're going to do is just break it up into a general fund, and they're just going to give you a minimal, return on that, and it's going to guarantee income, blah, 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 right? No big deal. What we want to do is we want to grow the funds, right? And the advanced market products and strategies that we have that have existed since 2022 are so far beyond what we had prior to that date, okay? Because since we've been, especially in this high interest environment, we've been able to lock in some solid roll-up rates, some premium bonuses on income bases that are literally unprecedented. We've never seen this before in the markets like what we're seeing today. The index strategies that we're using today are more refined than they've ever been in our nation's economic history, okay? So for one, we want to protect principal. We don't ever want to lose money, right? We talk about this week after week, right? What's Warren Buffett's number one rule? Don't lose money, right? Number one rule of investing, don't lose money. What's rule number two? See rule number one, right? Exactly. So we want to protect your principal. We don't ever want to lose, and we want to keep it safe from market crashes. Then we want to lock in those gains. So when you earn money year after year, unlike having it invested directly into TSP, we want to be able to keep that money when you earn it year in and year out so that it continues to compound at higher and higher interest rates every single year. Okay. And then we want to protect your spouse. Okay. Because that's something that, the markets unfortunately can't guarantee, right? In fact, they can't guarantee anything. Investing directly in the market doesn't guarantee anything except that your money is invested in the market, right? That's the only thing that's guaranteed, right? So your spouse is not protected using a direct market investment strategy or a qualified fund like what you have with the TSP. So we want to protect your spouse, and we want to guarantee that if something happens to you, right, before your spouse, if you happen to pass away before your spouse, that they're going to continue to receive the full amount of that income that you're drawing every single year for the rest of their life as well, right? So that they don't have any hiccups in their income while they're enjoying the rest of their living years in their retirement, okay? And there's added benefits and added bonuses that we get with these type of strategies too. There's living benefits that are going to actually double that income if something were to happen, like a critical illness or a terminal illness or a chronic injury or chronic illness, critical injury. That basically kept you from, 2 of the 6 activities of daily living. You're going to be able to double that income and be able to enjoy that for the remainder of your life, okay? And then the main thing too, if you look at the last row that we have here, is 0 out-of-pocket costs, right? Because you might be thinking, well, this sounds like a real dream solution, but my goodness, how much is it going to cost me? Well, the answer is a big fat 0. It's going to cost you 0. And in fact, the strategies that we use, the majority of them do not even involve any kind of internal fees. They certainly don't include management fees. Now, if we're guaranteeing lifetime income, sometimes that can come at a very, very marginal cost. Usually it's about 1%. Okay, but there are no management fees, right? I don't do assets under management. That's not my line of work. My line of work is to reposition these funds into optimized assets that are going to pay you every single year, and you're not going to have to pay out of pocket for any of this. There's no upfront fees, no annual management fees. Okay, so now you might be asking yourself, well, what the heck is a private pension? I hear Dan talk about this on the YouTube channel. I hear you mention it on your Facebook and your Instagram, which, by the way, if you're not following us on Facebook and Instagram, make sure you subscribe to those, okay? And if you go over to the YouTube channel, we'll put the links in the show notes, basically in the comments after the episode. But if you're not subscribed on Instagram or Facebook, you want to get over there and check those out, okay? Also, I'll go ahead and put the link down below to my personal calendar. So if you want to want to schedule a call on the calendar, book a free strategies call, absolutely no cost for it. I'm happy to have those conversations, and we can talk about how these strategies can benefit you and your family for the rest of your lives and the rest of your family's lives, okay? So what is a private pension? Well, the RETIREMAX Elite strategy, I got a bug flying around here. The RETIREMAX Elite private pension plan strategy, you can think of it as your own military style pension, right? But it uses your TSP funds, so you basically own that pension. So you guys realize that when you get a pension from the military, you don't actually own that, right? You realize that, right? Yes, it's contractually, obligated to you, but you don't actually own those funds, right? The government still owns those funds. They're just simply liquidating them, annuitizing them, as we would, annuitizing them for you on an annual basis. Okay, so what we do here with the private pension strategy is you own the principal, you own the pension, right? And you can decide what year, what age you want to turn that on. You can decide how you want to fund that. You can decide how you want to grow that. And we have a number of different strategies that we can use for all of that. Okay, so basically how it works in a nutshell. So we take, your TSP funds, after you separate, after you retire, we can take your TSP funds. We can take existing 401ks that you might have, existing, qualified accounts that your spouse may have. Okay, we can look at IRAs, we can look at mutual funds, we can look at stock portfolios, all of the above, right? We have the ability to aggregate all of these funds into a single tax-deferred rollover. Okay, so we take the full strength of your wealth up to this point, and we can roll it over into a single combined aggregated fund. Now, if there are Roth, funds, we kind of, there's considerations there for how we separate those. But if they're traditional, we move them all in there, tax-deferred, and there's no tax bill whatsoever due on the rollover itself. Okay, we're not paying any early withdrawal penalties. We're not having to come out again, out-of-pocket costs. None of that exists. We're just rolling it all together. Okay. Your money is going to grow with market protected gains. Okay, so if let's say we were to put it into a growth strategy where the money was linked to, let's say, the S&P 500, okay, we've got options that can cap out at 10.5%, 11%, right around there. Maybe we receive a premium bonus depending on whether it makes sense. Maybe we don't. Maybe we just link it directly to the S&P fund and we just grow it at roughly 10.5%, 3 out of 4, maybe even 5 out of 6, years, right? And even when the markets turn down, which they're going to, right? I mean, we're going to get market dips. That's just the way the economy works. But when it does, you're not going to lose money, right? You might not earn much that year. You might get a 0, but in that year, 0 is your hero, because I would much rather have a 0% credit than going negative, right? Because negative now takes me extra time to have to build back up. Okay, so we want to convert these funds to guaranteed lifetime income, which is where the pension part comes in. And we want spousal continuation, so that if you pass away first, your spouse is going to receive what we call a survivor benefit, meaning that he or she is going to receive that money for the rest of their life. Okay, and then optionally, we want to add on a legacy benefit, right? So we can actually use some of that liquidation, right, to fund a legacy benefit if we want to, so that you'll have a larger sum of tax-free money that's going to pass on to your kids at the end of your life. So it's a pretty straightforward mission, right? It's turning your savings into paychecks that you can't outlive, right? It's as simple as that, turning them into paychecks that you can't outlive. Okay, so now if we compare the two side by side, so again, traditional TSP is going to be exposed to market drops, potentially crashes. Now you have to self-manage all your withdrawals from the TSP, right? You guys realize that. You have to manage that. You have to decide every single year when you look at your funds, how much am I willing to, withdraw based on how the markets are performing at the time, right? We'll talk a little bit about sequence returns later on in the presentation, but also understand that, again, when you're invested in the TSP, it's not like having your money in a savings account, right? You're holding commodities, you're holding equities when you're in the TSP, whether they're bonds, whether they're stocks, whatever, mutual funds. It just depends on the funds that you're invested in, right? You're holding those. The way that you access funds is you have to sell those. Okay, so now you're kind of in this you're almost kind of in this brokering business where you're having to decide when you want to sell, right? Because obviously, what is the aim of investing? It's to buy low and sell high, right? So do you want to be having to worry about timing the markets every single year, potentially every single month, right? Every single month, are you worried about timing the markets? Do you want to worry about timing the markets to try and optimize the buy low, sell high every single time you go to withdraw funds? That's going to create a lot of stress and worry, especially during market downturns, okay? When the markets drop 10, 15%, that's going to cause stress, right? And ultimately, that worry is about running out of money, okay? We used to say that, public speaking was feared more than death. But in recent years, I'm talking like the last 10 to 15 years, and as they've kind of done more surveys, they found, especially among retirees, that the idea of running out of money is actually a greater fear than death itself, right? People are more worried about running out of money, when they're 85 years old and they really can't work at that point, because then what are you going to do? You're going to just live off of your family. You're going to have to force your family to support you, or you're going to just be forced into some government subsidy program. That's not what we want. That's not financial freedom, right? That's not what we're about with Victory X. So instead, we have the private pension plan. This is a zero market risk plan. It's got a protected floor, the 0% like we just talked about, predictable paychecks. You know how much you're going to receive and at what age you're going to receive them. So if you wanted to defer income, let's say your plan was to start drawing at 67, but you get to 67 and you say, you know what, maybe, based on my Social Security, my pension, whatever, I can wait a few more years, right? Well, if you wait a few more years, you'll know exactly how much you're going to be able to receive if you wait until age 69, 70, etc., right? So it's sleep at night kind of peace of mind and knowing that you cannot outlive your income, right? And neither can your spouse, again, if you're married. Okay, so when we're talking about sequence of returns, again, I know this is kind of jumbled here and it's a little technical, but if we talk about why market timing matters. So let's just say we have two retirees, for instance, and both of them are starting at age 60 with $400,000, okay? And we're going to average 7% a year of growth in both of their portfolios. Okay, now both of them plan to start withdrawing 5% of their balances each year at age 67. Okay, so the difference in whether they run out of money or how much they're able to draw really has a lot to do with when the market drops happen. So in scenario one, we're going to look at, a 20% loss in the markets at age 67 and then a 30% loss at age 74, right? And what does that look like? Well, when they go to start income at age 67, right? Let's say they've grown at, 7% a year, right? They're going to be taking roughly about 26,000, but if they're going to start taking income, that market drop is going to set them back to 26,000, okay? And then at age 74, if they get another 30% loss, even if they've been averaging 7% along the way, right? They're going to be down now to 19,000, and they're barely going to claw their way back to 22,000 a year by age 81. Right, but if we look at scenario B, okay, if you kind of go across there, you see, I'm trying to, yeah, there you go. You go to scenario B, you look at the same losses, but instead they happen later in life. So this is now, let's say, a couple that's, that experiences the 20% loss at age 74 and the 30% loss at age 81. Well, by age 67, they're taking about 33,000 a year, right? Because they're not experiencing the loss till later. By age 74, they've already built up enough principal in their average returns that now they're able to still draw about 40%. But if they hit that loss again at age 81, it's going to drop back to where it was before at roughly 33,000. Okay, so you can see how these sequence of returns risks, or the sequence of return risk, will ultimately impact how much you can draw. And again, you're having to worry about this, right? Every time the market drops, you're not sure when it's going to rebound or how well it's going to rebound or if it's going to continue to drop again. We don't know, right? That's just the crux of investing in, directly in the markets, is we just don't know, right? It's kind of a gamble, right? It's an educated gamble, but it's still a gamble nonetheless, right? And the key takeaway here is if the market drops right when you start taking income, your retirement check can shrink basically for the rest of your life, right? Again, these people both started with $400,000, right, at age 60. They both were on track to be able to start drawing 33,000 starting at age 67. But as you can see here, in scenario A, they were already down at 26,000 and they never fully recovered from that. They never recovered, right? Because they were just trying to keep up with the market cycles. They were trying to keep up with their gas and groceries and green fees and all that other stuff and trying to pull money out of their account to be able to fund all those things. And yet they were still chasing that loss of compounding interest on their principal because they experienced that when they did. And in both cases, they ended up losing thousands of dollars worth of growth, even if they experienced the losses later on. So how we do this is very simple, okay? The first one, obviously, we're going to protect the accumulation, okay? We're going to lock in market gains when they happen in your private pension fund. We're never going to credit losses when the market drops. So again, zero's your hero, zero's your floor, okay? And then we're going to flip on that guaranteed income whenever you're ready, okay? If you want to start taking income at age 65, you can certainly do that. If you want to take it at 67, if you want to take it at 70, that's entirely up to you. And you'll know what that looks like in advance, right? So you can plan appropriately without having to worry about what that's going to look like or what the markets are going to do later on, right? So we pick the right tool based on your age, right? Because not every age is going to be a universal solution. Okay, if you're 60 years old, if you're 40 years old, these are going to look significantly different, right? Potentially. Recommended that they look different because, again, if you're in your 40s, which we'll look at a couple of scenarios and we'll kind of compare those here in just a few minutes. If you're in your 40s, you still want to be focused on growth, right? We don't want to necessarily just jump right into an income product that's going to limit you, after, let's say, 10 years, right? We still want to plus up those funds, and we want to maximize the gains on that every single year so that then we can roll into an income strategy when we're about 10 years out from starting to draw the income. Maybe 10 to 12, roughly speaking, okay? And then when you're ready for the income, we flip that switch. Again, there's no fees, no out-of-pocket cost to do this. We just turn the income on, and it functions the exact same way that your pension does every single month, right? It just gets automatically deposited in your account with the guarantees of lifetime income for you and your spouse and the guarantees of living benefits if, God forbid, something were to happen to you that caused you to be, again, a chronic illness, a terminal illness, a critical, impairment that, you lost those functions of daily living and needed care, right? You're going to have additional protections there. Okay, so let's look at scenario number one. Right, so scenario number one is a 42-year-old couple, and let's say they've got $200,000 in their TSP when the veteran husband retires at age 42. Okay, and the husband and wife both 42 years old. Okay, so in this case, you've got a retired military couple, both age 42, $200,000 in the TSP. So again, we're looking at growth here, right? We want to try and plus these funds up as much as possible, get as much capital gain as we can between when they retire and when they want to start drawing income off of their policy. So we're going to roll this into a tax-deferred account, into a protected accumulation plan, right? Which is kind of a subset of this whole RETIREMAX Elite private pension, right? We want the protected accumulation plan, and we're going to link this to, we'll just say, the S&P 500 with a 0% floor and a 10.5% cap. Now, these cap rates are subject to change, right, depending on market conditions. But since we're in a high interest rate environment right now, that 10% cap is, or 10.5% cap is going to be guaranteed right out of the gate. Okay. Again, no out-of-pocket fees. We're just going to simply move the funds. We're going to reposition them from a market risk account, an at-risk account, to a market protected account, completely transparent. Okay. And we're going to do this over a 10-year growth phase. So think of that 10-year phase as like our acceleration, accumulation phase, right? And over the course of that time, that balance, that $200,000 balance, is going to grow to approximately $400,000, like $398,000. That's a conservative estimate. Okay, that's based on market historics, the historical data from the S&P 500, based on these participation rates, right, and based on this cap rate with this particular strategy, right? We're gonna estimate, we're gonna expect that this is going to grow to at least $398,000, almost $400,000. Okay, and then what we're going to do at the end of that. Now, again, this is, we could have additional options that come online between now and then that could provide us with even a lot more gain, right? But we'll say at that point, based on what we're projecting now, we're going to roll those funds again. Also, again, no out-of-pocket costs. We're going to roll those funds again into a second, like a part B of the RETIREMAX Elite private pension plan that's going to give us an 8% automatic bonus on our premium. Okay, so 8% is going to be automatically credited to the income base of that $400,000, right? And then we're going to get a guaranteed 8% roll-up, meaning an 8% return, guaranteed, right? This is contractually guaranteed, folks, every single year up until age 65, okay? And then at age 65, when their income base has grown to over $1 million, remember we started with 200,000, right? Now it's grown to an income base of over $1 million. We're going to turn on income, and that income is going to look like about $70,000 per year for life. Okay, and it's going to be paid out, liquidated monthly. Okay, so divide the numbers up. What is 70,000? You do the math, right? That's how much you're going to get per month, right? With full spousal continuation. So your spouse is going to keep that full amount, that full 70,000 every single year if the veteran passes away first. Or if she passes away first, he's still going to get it, right? So there's no loss, right? If she passes away first, he's still going to receive the 70,000. If he passes away first, she's going to receive it for the rest of her life. So what does that look like, really? Well, over a 30-year period, we've taken $200,000 and we've converted that into over $2 million of income, guaranteed income, $2 million off of a $200,000 investment. And that couple never had to worry about what the market was doing. They never had to worry about buy low, sell high, all that stuff, right? What happens if there's drops? What happens if there's crashes? And they never had to worry about how long they were living, right? They never had to worry about what happens if I live to be 95 or even 100 years old, right? You're still going to have that 70,000 a year no matter what happens, guaranteed. Okay. All right, so let's look at scenario 2. So in scenario 2, we're talking about a little bit older couple, right? So age 60, right? And again, we're going to assume the same. They're the same age. But in this case, we'll say, hey, the husband has been, maybe, or the couple has been working, in the federal system for the last, 20 plus years. So now they've got about 500,000 in their TSP. Okay, so they continued to fund it after retirement while working in the federal government. So now we've got about 500,000. This could be 500,000 combined with IRAs and 401ks and whatnot, but just 500,000 in general. Okay, and they want to start taking income off of their policy, which is also going to accompany their pension, their Social Security, everything else they have coming in. Right? They want to start taking income at age 67. Okay, so now we're going to kind of bypass that accumulation phase, right? We're going to kind of just jump right into a product that's going to guarantee growth, but is going to be linked to the index and is also going to guarantee income right out of the gate. So they'll know exactly how much income they can draw at the various ages, literally from day one, right? We don't base this off a chance. Right? We don't roll these into plans based on what they might do, right? These are plans that we get invested in early on based on what they will do and what we know that they'll do from day one. Okay, so they've got a couple of they got multiple income options, right? If they start income at age 67, it's just over $60,000 a year guaranteed for life, right? We didn't have as much time to accumulate funds, but we already started with a higher amount, so they're going to be looking at just over $60,000 a year that's going to be guaranteed for life. But look at this. Look at what happens if they wait until age 70. Let's say they get to age 67, and now, like I said, they've got Social Security, they've got pension funds that have been cost of living adjusted. Maybe they've got VA disability coming in. Okay, so if they wait until age 70, that $60,000 a year is going to jump up to over $80,000 a year. Again, guaranteed for life. They get an extra $20,000 a year just by waiting 3 years to start taking income, right? That's something worth considering, folks. I'm not saying that you should do that, but I'm saying it's definitely an option, and it gives you choices, right? It gives you flexibility. And you don't have to worry if this couple decided at age 67 that they wanted to wait a few more years. They have not one care in the world as to what the markets do between age 67 and age 70. Not one care in the world. They just decide, hey, we want to take our pension fund at age 70, so now it's going to jump up to over $80,000 a year. And again, with full spousal continuation. So if either spouse passes away, the survivor keeps the remaining full amount. So if that starts at age 70, it's $80,000 a year for life, and over 20 years, right, 20 combined years, let's say, you're talking about $1.6 million paid out in guaranteed income. Now, if there's any remaining balance, right, in their account, which probably won't be, right, if we're maxing out our income every year, probably won't be any remaining balance necessarily. But if there is, it's going to confer, it'll be tax advantaged, we'll put it that way, to their beneficiaries. It won't be tax-free in this case, but we do have options that we can make that tax-free, and we can actually create a separate legacy for their estate. Okay, so again, if we compare the two scenarios side by side, just to kind of review, you can see what that looks like. Okay, if we start with the 200,000 TSP for the 42-year-old couple, we put that through a phase one strategy where we go 10 years of protected growth, right? We maximize accumulation. Income base starts at age 65, right? We rolled those funds again at the 10-year mark. We put them into an income strategy, income starting at age 65, and we guarantee 70,000, roughly 70,000 a year of income for husband and wife for the rest of their lives, no matter how long they live. Lifetime total about $2 million. Okay, for our 60-year-old couple, we're starting with 500,000 TSP. They want income growth that starts immediately. Okay, so we're going right into an income strategy. They're going to get guaranteed 8% growth up to age 67 or 70, whenever they decide to turn on that income. At that point, we're going to level off the roll-ups, and they're going to be able to take anywhere from $60,000 to $80,000 a year for the rest of their life with full spousal continuation. No market risk in either one of these strategies. And in the first scenario, again, $2 million of lifetime income, roughly speaking, could be more, right? If they live longer, it's going to be a lot more. In the 60-year-old couple, if they live, if they take income for 20 years, a little over $1.5 million. Okay, so if you're a younger veteran, we focus on growth first, then we switch to income later. Older veterans go straight into guaranteed income strategies, but both paths eliminate market risk, protect your spouse, and deliver monthly paychecks guaranteed for life. All right, so common questions that we hear on this, right? Do I pay taxes on the rollover? Well, again, these are tax-deferred strategies, so the short answer is no. Right. The short answer is there's still going to be a tax bill potentially on the distributed funds later on, unless we convert them to Roth funds and we get the taxes out of the way and done with early on, which that'll be a separate topic for a separate Military Money Mondays episode. We can talk about Roth conversion strategies and why we might do that to basically offset the taxes later on. But suffice to say, there's no tax bill due when you just roll these funds over, right? That's entirely tax deferred. So no out-of-pocket costs, no extra tax bill, no early withdrawal penalties, as if you were just pulling the money out of TSP altogether. Okay. And again, if you want tax-free income later, we can layer in strategies. We can use, index universal life strategies to supplement this, or we can use Roth conversions to basically alleviate that future tax bill. Okay, and then what if I die first? Well, we talked about this. Obviously, your spouse continues receiving the full payment, right? Not a reduced amount. This is not like SBP where they're getting 55%, right? No, this is the full amount, right? So if you're getting $70,000 a year as a couple, and one of them passes away first, the other one's still going to get $70,000 guaranteed for life. Guaranteed for life. Okay. Can the income ever go down? Absolutely not. Right? In some cases, it can actually go up, right? Depending on the strategy and depending on the product we use, it might actually go up depending on market performance, but it will never, ever, ever go down for the rest of your life. It's locked in for life the minute you turn on that income. Okay, again, no out-of-pocket advisory fees. I don't charge any management fees, right? I am not what you would call a financial advisor, okay? If you look that up, that's an actual licensed title, okay? I'm not a financial advisor, right? I'm a licensed financial professional, but I work in a separate side of the industry, so I don't do what's called assets under management, right? Meaning I don't have to charge management fees to my clients just simply to manage their funds year to year, right? We get paid, separate commissions from the carriers that we work with. It does not come out of your principal. Okay, so if you're rolling over $400,000 or $200,000, let's say, no amount of that is going to pay my fees or my commissions or anything, in terms of my compensation, right? That's totally separate from your principal growth. Okay, the income riders are baked into the contract mechanics. Again, those come typically with a nominal fee that comes out of the principal growth. It's roughly about 1%. And the insurance company covers the additional management costs year to year in the policy. And then again, can we leave money to our kids? Yeah, absolutely. So any remaining value, if there is any in there, we'll transfer to your beneficiaries. But what we can also do is we can actually layer in tax-free estate strategies on top of this that would basically maximize it. These are essentially like life insurance type strategies that will guarantee a tax-free death benefit, right? That will actually blossom at the end of your life and confer to your beneficiaries tax-free if you want to do that, right? Some people may not want to do that, but I mean, if it were me, I would want that. I would want my service to convert into a tax-free legacy for my family so that I would give them a head start in their lives and their financial futures by injecting, let's say, several $100,000, that might be good to roll into their own RETIREMAX Elite plans that they could start much younger and they could grow to much larger sums, right? So, I mean, to me, it's kind of a no-brainer, but I understand it's not for everybody. I would just like the idea that my service to this country would then result in me being able to pass on a tax-free legacy that my kids, my grandkids, my great-grandkids are all going to remember me because I was the one that basically helped to, jumpstart their financial futures and really, really put them ahead of the game in terms of their future retirement planning. Okay, so again, why zero loss compounding wins in the long run, risk versus reward. The down years create big holes that are hard to climb out of. If the market drops 20%, you actually need a 25% gain the following year just to break even, right? How many years do we see where the markets are up 25%, right? It's in the general funds, it just doesn't happen very often, right? And so, I mean, in a good year, you're looking at roughly 13, 14, maybe 15. But in most years, we're not going to hit 25%, which means that you're going to have to accumulate funds over the course of 4 to 5 years, typically, in order to break even from where you were before. Okay. But with a protected floor at zero, if you think of it in terms of like a ladder, right? If you were just cruising along and let's say you had $100,000 and you earned 10%, so now it's up to 110, right? And then we hit a 0 year. Well, all we're going to do is just sit there at 110. And then the next year we're going to go up again and go up and so forth, right? So this matters the most when you're taking income off of your retirement nest eggs, right? You can't afford to lose 20 to 30% if you're drawing income. A lot of times that's either going to run the risk of running out of money or you're going to end up having to go back to work or find some other way to survive because this ain't going to cut it, right? And what we find is, incidentally, more retirees actually die with larger sums of money still in their savings accounts, right? Because they're simply afraid to use it, right? They're afraid to use it. They're afraid, well, what happens if my health, changes and I need this money for emergencies? What happens if, the markets tank and the housing market tanks and I can't afford to pay, off my house or something like that? That's not financial freedom, folks. You worked hard for that money, right? You worked hard to build your nest egg. Why would you not want to enjoy it every year? And enjoy it means with peace of mind to know with 100% certainty that you're never going to run out of money, right? It's not about chasing top returns. It's about paycheck reliability and peace of mind in retirement. And that's what we do for veterans with VictoryX Financial, okay? That is one of our core mission strategies that we focus on, and we help veterans with this every single day, okay? We help veterans achieve that financial peace of mind that all of us would love to be after, right? Because that's what I feel like they've earned, what I believe in my heart of hearts that veterans have earned by serving this great country. Okay, so who is it for? Who's it not for, right? I mean, with VictoryX Financial, we're all about transparency. So if this is not for you, right, if you want to day trade, right, you want to chase high-risk investments, this is not for you, right? If you want full liquidity of every single dollar, right? Now, if you want full liquidity, we have other strategies that would be great for that, right? But that's not the topic of tonight's discussion, right? If you want full liquidity, this is probably not the answer. Now, you're going to have partial liquidity, right? So if, let's say, you rolled over 200,000 and the next year you needed 20,000, you needed to advance 20,000 from your account, you could do that absolutely 100%. Free of any surrender penalties. Now, you're going to get, if you're under the age of 60, you're going to get an IRS penalty for that. But if you're over the age of 60, you're not going to have any penalties at all if you wanted to access up to 10%. But we want to grow this. This is a long-term growth strategy. We're in it for the marathon, not the sprint here, okay? And if you're comfortable managing market swings on your own, then hey, by all means, man, more power to you. This is just another option that we can look to that's going to, again, if you've got 5 to 10 years to retirement and you want protected growth without market risk, or even if you have 0 to 5 years to retirement and you want guaranteed income that's going to start relatively soon, right? And if you want to protect your spouse, if you're married, right, you want guarantees that if something were to happen to you, your spouse is going to receive income for life. This would be a great option, right? And anyone essentially tired of market stress, right? Ready for those predictable paychecks. I know a lot of veterans out there, right? I'm one of them that is used to receiving that mailbox money every month, right? We lived and died on pay charts, right? Pay scales and promotions and all this guaranteed income, that was coming in. We like to be able to enjoy that in retirement, right? We like our pensions. We like our predictable income streams. We don't want to risk it in the markets and have to worry about what's going to happen as we're riding that roller coaster year in and year out, right? And really the reason that we put all this information out there, again, it's all about education. It's all about clarity. It's all about honesty. And frankly, if this fits your mission, if this fits your lifestyle, and you think, yes, I want financial peace of mind in retirement, I want to be able to secure that today. I want to know when I get to, whatever retirement age that might be, that I'm going to have a guaranteed stream of income I'm never going to be able to outlive, then this might be something that we should talk about, okay? And the best way to do that, again, down below, my calendar link, go ahead and jump on there. You can book a free 30-minute strategy call, guaranteed, no obligations, okay? Even if we don't end up doing business, I'm still in it to educate veterans and empower you with as much information as I possibly can, because I feel like I owe it back to the veteran community to do what I do. Okay, so even if we don't do business, that's fine. You can take my ideas and run with them. If you want to take them to your own broker, that's fine, right? Of course, I always prefer that we do business together, but if not, hey, that's no hard feelings there, okay? I'm just happy to have these conversations and happy to help educate and inform and empower, et cetera, et cetera. Okay, so again, if you guys are interested in this, the next steps would just be simply to, again, book a call. You can just type the word income, right? Type the word income into the comments section below, and I will reach out to you specifically, and we can get connected and we can have this discussion, right? So if you're interested in this stuff, type the word income below, and we can talk offline about how this can benefit you. And on top of that, I'm going to even throw in a bonus strategy. So if you're watching here tonight, again, on Military Money Mondays, if you comment the word wealth, okay, you comment the word wealth down below, I'm going to send you a free copy of our Veterans Wealth Guide. It's the RETIREMAX Elite Veterans Guide to Tax-Free Wealth and Financial Freedom. You can see here, I am the author, Daniel Farnsworth, published this book. It's available on Amazon. It's about $13 if you want to pay that and pay the shipping. But I'm telling you right now, I'll send you a free copy. Just comment wealth down below. I will send you a free copy of our book, RETIREMAX Elite, the Veterans Guide, and I will even cover the shipping. Okay, how about that? We're coming up on the Christmas season, so I'm going to even cover the shipping for you, right? And I'll send it out to you this week. Comment wealth down below. I'll send you a free copy of the book, right? I'll even sign it for you. How about that, right? No, I'll pay for the shipping. I'm serious. I do this on a regular basis. So with that, you'll be able to receive, we'll be able to do an audit of your current financial situation. We can give you an exact income projection based on various ages. And you can just kind of make your decision, right? I'm a zero pressure kind of guy. I will give you all the information that you need, the tools that you need to be successful, but I'm not going to pressure you into a sale, because at the end of the day, I don't benefit from high pressure, right? I don't benefit from spoiling my reputation and putting veterans in compromised positions, right? I benefit when my clients benefit, right? That's what I'm in it for. I want you as a potential client to be recommending these services to your friends and family because you see the value and how well it benefits you as an individual. All right. So let's go ahead and go back up top, and we'll go ahead and finish this up. All right, guys, so there you have it. That was our Military Money Mondays topic for this week. Hopefully you got something out of this. Again, we'll be back next week. It's 5 p.m. Eastern. Every week we're here for Military Money Mondays. Again, leave me a comment down below. Do you like this format? I kind of dig it. Like I said, I'm experimenting with different styles here. We were using sort of a direct record StreamYard before, but this is a little bit more, we'll call it sophisticated. But let me know in the comments if you like this. And like I said, next week we'll be back. I also will be in the chat group. If you guys are watching on Facebook, we have our own chat group. If you're interested in joining, just shoot me a quick DM or just put a comment down below that you're interested in the group. I'll send you an invite and bring you in. We talk about this stuff, answer questions every single week. We put out new information. Again, follow us on Facebook, Instagram, YouTube. If you're watching on YouTube, check out the other videos. We would love to get some feedback on those. If you're not subscribed to the YouTube channel, recommend doing so. We put out great information every single week on YouTube, both long form and short form. And again, this is all free of charge, right? So you're getting some exclusive information that you're probably not going to find anywhere else, at least not in the military or not in the veteran circles. You're getting some exclusive information, and you're getting it from people that really know what they're talking about. Because, like you, I've walked in those boots. I've lived that life. I served 23 years active duty. I retired. I'm familiar with veterans benefits and all the rest of it, right? VA disability and all the things that were supposedly promised and offered in retirement. Okay, so with that experience, right, I can couple that with my financial experience, as a licensed professional, and really provide a product that's tailored to the veteran community. So again, we'll be putting out during the week. I don't know what the topic is for next week yet, but we'll be putting that out during the week. So stay tuned for that. And otherwise, we'll see you guys next week on Military Money Mondays. My name is Dan Farnsworth. Again, this is Victory X Financial. I'll see you guys next week.